how much they have consumed? $300 they have consumed. So this supplies, which are our assets, now they need to decrease 300. So when as supplies decrease, credit, right? So this 300 will be expense to income statement. So supplies expense to supplies. So if you go here, supplies is credited, supply will go here, and supply expense will go here. This will go to income statement as an expense, and we have a balance 400. This is how we make accounting, accrual accounting. Guys, you understand? It is the same.
Yes, sir.
Entries, just we are posting it just when we name it as adjusting entries. Now, this is the breakout room activity. So I'm making the group. Meanwhile, please copy it or take a picture. This is a group activity. Let me make the group. So those who are watching online, please stop the video here and try to do it by yourself. And after that, I would be resuming the recording as well. Okay, please accept the breakout room. And I'm going to pause the recording right here. Okay, class, welcome back after the breakout room activity. So those who are watching online, the recorded lecture, so please compare your answer here. So let's do it. So at the beginning of the month, supplies were 5,000. So during the month, 7,000 supplies were purchased. At month's end, 3,000 supplies are still on hand. So 5,000 were on hand. You purchased 7,000. How much? 12,000. So your complete balance of supplies, 12,000. On hand, right now, you have 3,000. So it means how much you used? 9,000. Right? At the month's end, the balance the balance is 3,000. It means 9,000 you have consumed. So entry we're gonna be adjusting entry gonna be supplies expense to supplies. Ending balance, we just talk about this. It is still on hand, which is 3,000. So are we clear? We have one chat. Okay, Nana. Okay, let's move forward. Okay, for depreciation, let's take a break of 10 minutes and then we start from here. Let's take a 10 minutes break. Okay, class, welcome back after the break. So now let's start the second category of adjusting entry, which is depreciation. So if you don't understand the depreciation right now, please don't worry. We have a separate chapter, whole chapter on depreciation. So if you understand right now, well and good. If you don't understand right now, please don't worry about that because we have a whole chapter to discuss this depreciation stuff. So depreciation of plant assets. So what are the plant assets? They are fixed assets or long-lived, long-life assets. Which kind of assets? Tangible, which we can just touch and all the stuff. Feel, we have a physical presence. So land, building, equipment, furniture. So the assets are recorded when they are purchased, right? Exception of the land, because land is not depreciated. The value of the land always appreciated because of the limited supply. We cannot increase the supply of land. Land is fixed, so that after every year land prices, market values go up. So the depreciation is the decline of the usefulness of the assets. So we record depreciation over the assets useful life. For example, laptop is for 5 years, building is for example 10 years. After 10 years we need to demolish it, or we need to renew it, or whatsoever, right? So depreciation basically is not a reserve fund. It is not some kind of actual cash expense. This is just a process of allocating cost of the long-term assets to expense. Whatever we purchase for business, that is our expense. But this plant asset is long-lived. We purchase for number of years, right? So we divide its cost on number of years basis, right? So every year, some portion of the cost of asset will go to the income statement. So here we go. Suppose that on June 3rd, Friday Auto Service purchased equipment on account 24,000. So on account means these are purchased through cash? No, through credit. So what is the entry? Equipment increases and
accounts payable.
Well done. Account payable also increases. Account payable is liability. Liability increase credit. Asset increase debit. Equipment to accounts payable, right? And now, since we purchased it on June 3rd, now Friday equipment will remain useful for 5 years, then it is worthless, which means they're just gonna throw it. It's not gonna be resold or don't have any salvage value or residual value. So one way to compute the amount of depreciation is to divide the cost over the life of its useful life. So this procedure is called straight line depreciation method. Don't worry about the method. There are 3 methods or 4 methods we'll talk about in depreciation. So how we are going to calculate the depreciation? Sorry, calculate the depreciation. 24,000 divided by useful life is 5. It means 4,800, and that is per year. Per year. Be very careful about the dates. So monthly, you divide 4,800 to 12. Answer is going to be 400. Now, depreciation for June. They purchased on June 2nd or June 3rd. Now, at the end of the June, they need to record this monthly depreciation, not annually. Some students, they mistakenly just calculate, okay, 5 year divided by 5, 4,800. Okay, June depreciation is 4,800. No, 4,800 is per year. So you divide further with 12 months and you have 400 per month. So June depreciation is 400. So the allocation of expense, normally what we do, expense to asset. But here in depreciation, we create contra account. Contra account. We call this accumulated depreciation. So that we know that how much depreciation we have recorded until its life. How much is the total depreciation? Because expense will go to income statement. Every year income statement going to be having a profit and all the stuff. So we don't know how much we have allocated the total amount of depreciation. So we create contra account. Contra means opposite account of asset. So when asset account increase, it is debit. But when accumulated depreciation increase, it is credited. They are not liability or owner's equity, but these are opposite of asset account, and it is recorded on the asset side as well. So here we go. Depreciation to accumulated depreciation. So this will go to balance sheet, and this will expense will go to income statement. So equipment 24,000, right? Equipment remains 24,000. so that we know that how much we purchase for equipment, 24,000. How much we use, we see on the balance sheet side. Sorry, not this one. This is accumulated depreciation. So we also see this on balance sheet. So how much we have used this asset? Only 400. And we see that 400 is monthly depreciation. So it means this is relatively new equipment and we only use it for 1 month. And total cost, we purchase it for 24,000. So this is just one unique way, because in a company, there is not only just one equipment. There are thousands of equipments. We have Xerox machine, we have air filter, we have AC, we have window ACs, we have, the fan, we have table furnitures, we have production plant, we have chairs, we have glass, many things. So that now we want to know that how much we have spread the cost over the life of the years. How much is the total accumulated depreciation? Now we want to know that. That's why. Now we want to know that. That's why we create a separate account called accumulated depreciation. Right? So many students, they say that why we created this account. This is not necessary. We're just gonna say that depreciation expense to equipment. That's it. There's gonna be entry. It's gonna be yes, but in that case, if you want to find out how much we have used it, we cannot find out. So this is one way to create contra account, which means if asset account increase, we create it debit, but contra account means accumulated depreciation. If it is increased, we make it credit. Here we go. So accumulated depreciation, it shows sum of all depreciation expenses. So this is not just one equipment. This is on furniture, on building, on production plant, on chairs, on furniture, on fixtures, anything. All complete depreciation. So that we want to know that how much is our total depreciation. So the balance increase over the life of the assets. It is a contra account. Contra which account? Contra asset account. And its normal balance is credit balance. Right? Asset normal balance is debit balance. So its normal balance is opposite of the asset, which is credit. A contra account has two distinguishing characteristics. Number one, it is a companion account. It always has its mother account. So its mother account is assets account. Plant asset or equipment, right? So its normal balance is opposite of the companion account. If companion account, if mother account is debit, then its account going to be credit. If companion account is credit, the mother account going to be debit. So how we are going to represent this in balance sheet? So remember, land, equipment less accumulated depreciation. So you write it down 24,000 here, which shows the price of the asset when you purchased it. And how much you have used. So you add it here in parentheses in negative 400. So total book value going to be less depreciation. So time to time, this is decreasing and this is increasing until it becomes zero. When zero, it means you have used this asset completely. All right. So book value of plant assets is going to be total. So land is our assets, equipment is our assets minus the depreciation. So 400 is less from here, this less. So that's why it is 441,600. Guys, you understand the concept of accumulated depreciation?
Yes.
Yes.
Good. So what is the entry to record the depreciation? Adjusting entry, depreciation expense to accumulate.